Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu. And on today's show, we have Rick Bensignor, who's the CEO and founder of the Bensignor Group. How are you today, Rick?
I'm well, Karem. Thank you for having me.
Let's begin by talking about how you started in the markets and your early days in the trading pits back in the 80s. What was it like back then to start out in the markets and be on the floor and trading all day? A lot of traders from that time usually think back fondly on that period before computer trading and the internet came along. Talk to us about that.
Well, I definitely look back on those years fondly. They were some of the best years of my career and certainly some of the most fun years of my career. I was fortunate that I was able to start pretty early in my career, not just on the floor, but in the actual trading pit as a broker in the pit for Prudential Beach Securities back then. This was the early 1980s. And they had selected me to be their stock index futures broker on the floor of the New York Futures Exchange. And just a couple years out of university, it was thrilling, to say the least, to be a part of the essentially creating price each day for that particular stock index. It was really fascinating, and you realized that this was essentially the core of trading in any sense of the word. There's nothing, no type upstairs trading could match the thrill of what it was like to be yelling and screaming all day, actually being truly a part of the market. And it's very different these days with computers. There are essentially very few trading pits left at all, and it's a whole different ballgame now. Correct.
Well, let's move on and talk about commodities and specifically gold and silver. So what is your view of the metals in regards to the current financial climate? That includes money printing, interest rate cuts and negative bond yields. And is gold back in a bull market in your mind, Rick?
Yeah, I do think gold is back in a bull market, having based for 6 years in between roughly 1,050 and 1375. Over the summer, we broke out to the upside. So it puts itself into a bull market. Now, it has at least temporarily stalled into a target, the first upside target zone that we told clients to. We were long gold since March of this year at 1295. And we exited at 1491. So it's currently trading, December gold in New York's trading at 1535. So, we've missed $40 or so of potential upside, but our target was to exit between 1487 and 1532. Now, if you look at the $325 range and you add it to the top of the breakout point of 1375, you can easily make the case that gold is going to 1700 over time. And I do think that is likely. Low interest rates is always a good thing for gold. And because gold is a non-interest bearing instrument, so when yields are high, people favor getting yield because you get some type of return besides the instrument itself. Gold, you only get the price appreciation or depreciation as the factor that determines whether or not you make or lose money. As far as the effect of monetary policy, money printing, negative interest rates, etc., it's kind of interesting. Again, some of those things are bullish for gold over time. And look, negative interest rates that you guys have over in Europe, we don't really have them yet here in the U.S. But I'd say it's so far unproven whether or not negative interest rates is actually helping things. That's yet to be determined, but I'll tell you that with much of Europe having negative interest rates, in many ways that it hurts individuals It may be good for corporations who can borrow for less, but it's not good for individuals, and it's certainly not good for older people who are in the retirement phase of their life, and they count on fixed income to provide income for them in coupons, collecting coupons, because they're not getting anything, and in some cases you actually have to pay the bank back. So all this is, though, potentially good for the precious metals.
You've stated in the past that you can have a lot of skill, but ultimately luck does play a big part in trading and investing. So let's talk about this in more detail. And as you gain more experience as a speculator, is the potential opportunity you're looking for easier to spot?
Okay, so let's talk about luck, I think, versus skill. I think in any career you have, it's a combination of your skill that creates much of your success, but luck also has a large part of it. Let's take, for example, Karam, somebody who's a trader at a sell-side firm. Let's say they're, on a fixed income desk and they're trading treasury bonds or something like that. You had to have skill to get that job in the first place. But the fact that you're sitting in the seat you are also provides a lot of the potential profits that you can make because you simply have the luck of being in that seat. And sometimes markets get such that you essentially can print money. You have enough buyers and sellers coming in at the same time that you simply take out the VIG throughout the day. And it's actually almost easy to make money. And I'll give you an example of where luck played a part in my career. Back in 1990, in October of 1990, on the day that we now call the mini crash, because that was just 3 years after the crash of 1987, I was an independent trader, what we call a local, in the stock index pit. And it was sometime in the afternoon, and somebody hits me on a 10 lot, and I'm just making a two-sided market like I normally did as a local in the pit. You're just trying to take out the VIG. And somebody hits me on my bid, and before I even have the trade carded, in other words, before I've even written it down on my own deck of cards to keep my position, there's this swell of noise, and all of a sudden the pit is offered down the limit. So now the stock index futures contract is traded lower, or as much as it can trade down before they actually close the market. So we're limit down, and I start calculating my losses, and I realize this is more than all the money I have in life. And this is the last day I'm ever going to trade. It's all over. And I've got to go home and tell my wife that I've lost everything. And while we're limit down, behind me says, "Who needs to sell some?" And I got right in his face and I said, "Me." And he said, I think it was by 15. So it flipped my position from being long to locking in my loss. And I'm now short 5 at limit down. So at the market opens at the next limit down because there were so many unfilled orders from the first limit down, so unfilled sell orders. So the market reopens at the next limit down, which is even a larger size in dollar amount of limit move than the first one. And I quickly bought back 9 contracts, which flattened me out from my short and actually had me get long. And we immediately started rallying viciously. And I kicked those out. And then I start looking at what my P&L is, my profit and loss for this 20 minutes of hell. And it ends up, I actually was not only net made money because I was able to cover the short at limit, the bigger limit down. But it ended up being my second best day trading in the pit in my career. So in a matter of 20 minutes, I went from losing everything I owned in life to having my second best day. Now, that comes down to luck, not skill. It was unlucky that I got hit on a bid that ended up selling all the way down to limit down. But it was completely luck that the broker who got a buy order at the first limit down chose me to fill his order with. Because if he picked anybody else, I wouldn't be talking to you now, because I would have lost not only everything I own, but everything my kids would have owned one day because of that next limit down move. So luck plays a huge portion of how one does in life. And I think you'd be hard pressed to find anybody who's successful or unsuccessful to tell you that at some point luck didn't have being in the right place at the right time, being in the wrong place at the wrong time. Just it's kind of life.
Yeah, some great insights there. Okay, let's talk about part of your methodology. And over the course of your career, you have been known to buy things that look as though they are completely beaten up and have reached a bottom of some kind. So how hard is it for you to buy near the bottom of the market these days? And has it gotten easier over the course of your career, Rick?
So interestingly, Karim, and I've mentioned this in some other videos I've done, is that as a trader back in the 1980s and 90s when I was in the pit, I was think about it, that was one of the biggest bull markets of its time. And I was always comfortable selling rallies. I was actually comfortable even selling declines. And I could buy when I deemed things to be, I could buy declines looking for bottoms. I had a real hard time buying strength and chasing after the market to bid when the market was going up. And over time, I've definitely gotten better about that, where I can buy strength now. But the whole come from that helped differentiate me from so many other people on the street is that the models I use to play the markets, whether from my own account or my advising institutional clients that I have, basically comes from the concept that we're all supposed to be playing with, but very few do, which is buy low, sell high. And the models I use help me define trend exhaustion very close to the actual point of a trend ending. Now, are the models always correct? No. But if you want to outperform the markets, the best way to do that is to play in the second and third standard deviations of price activity. When you play in the first standard deviation, we would say the fat part of the bell curve, it's very hard to outperform over time. You may make money in absolute terms, but if you're trying to beat a benchmark, it is very hard to beat a benchmark when you're playing in the fat part of the curve. The best way to do so, although probably the most difficult also, is to actually be able to get long near true lows and get out near true highs. So, for example, this year alone, the Christmas low from 2018, we had that close to our downside target for the move. And by early January, I had told institutional clients, not only is that December low a good trading low, but it's actually going to be and I mentioned this by, I think, January 10th, it's going to be the global low for all major equity indexes. Took place, I think it was the day before Christmas. So while so much of the world was selling into the rally and continuously sold into the rally, by me having been able to identify that that was not the beginning of a bear market, what we had just seen, but actually a pullback in what was still an ongoing bull market, made a huge difference to our performance this year because we were long almost the entire year. There's only 2 times that we haven't been long this year. And the losses were less than 1% each time. So the whole idea of being able to buy low and sell high. So even recently, we again lightened up in the S&P north of 3,000 for the second time this year. So this idea of buying low, selling high is if you can do it with models that help you truly identify ends of trends, then you have a much better chance of outperforming. And I realized that over 30 years ago, when I was still kind of a youngster in the marketplace, that because I'm almost on the street now 40 years. So fairly early in my career, I realized the importance of, first of all, separating yourself from what everybody else is doing, because otherwise you're a Me Too player and you simply only have the chance to be average. And secondly, if you think about the whole concept of buying low and selling high, which is textbook in the sense of that's what you're supposed to do, then I either developed or sought models that help fit into that paradigm. And that's how the street knows me best, is that I can sell things that other people say look great, but if I can identify that the likelihood is that we're much closer to a top than a bottom, therefore I don't mind taking profits and getting out of things when they look like they've exhausted themselves. So you always can get back in, right? Just because you sell out of something doesn't mean you can't get back in. But that's how I approach the markets, and it's proven to be rather successful over time. This year alone, Karam, my institutional newsletter, we follow every official trade that I suggest. And this year, as of August 31st, the last time once a month we update at the end of the month, we're up 72.5% on invested capital this year. Last year we made 24%, and the year before 75%. Again, on invested capital. Now, this is not running a full portfolio. This is saying each time we make an investment, if we total the returns of the money we've put into the market, we're up 72% this year. So, it's 3 years in a row that we've had outstanding returns simply by being able to time when and where to buy and sell the various instruments that we look at across the globe.
Okay, well, let's talk about some specific books or authors that have helped to guide you throughout your career. Is there anything that stands out to you?
Yeah, I'd say there are two that I kind of put into this category. One is a book and the other is a person. Book-wise, I'd say I learned the best basics of technical analysis from John Murphy's book, John J. Murphy, who, for those in the U.S. Who have been watching, let's say, CNBC for years now, he's not on regularly, but back in the 80s and 90s, he was kind of their in-house technician. And he wrote several textbooks on technical analysis. So the one that I learned from and also even used when I was teaching technical analysis at university, the book that I always recommend people use was Technical Analysis of the Financial Markets. So it's a big, fat, 3-inch high textbook, but it gives you very good basics on the market. So that's the one I still recommend to this day. And then as far as, let's say someone who's helped guide me, 24 years ago or so, I met Tom DeMark. And for those of your listeners who don't know who he was or is, Tom developed many, many models that institutions use. They're kind of higher end models. They're not so much textbook type stuff. In fact, you won't see them in textbooks. But he did write some books himself, and I had met Tom in the mid-1990s, and we've been friends since. And his models very much came into the same space of much of how I was looking to play the markets, which, again, was kind of buy low, sell high. And so I would say that his work, I continue to use it to this day. I wouldn't play the markets without it. It's the software you have to buy, and it only runs on a couple of platforms, so it's not so easily accessible. But if people want to, They can certainly find out more. You can look online about Tom and his company, Market Analytics. So I'd say Tom was, his work, both as a friendship with him as well as his work was, kind of significantly influenced my success over time too. And part of that is my interpretation of his models and my ability to use them effectively. So I would say, as far as resources, the textbook that John Murphy wrote was certainly important in just getting basics. And then my having used Mark models for, over 20 years now has helped me a fair amount in the success I have in being able to play the markets.
Excellent. Okay, as we begin to wrap up, Rick, is there anything else you wish to talk about today? Anything else on your mind?
In general, I think, playing the markets we see over time has become more and more difficult. I do think that computers, or call them machines, any way you want to, kind of call what makes up some 70% of all trading now, has clearly changed the game. And so back when I was a pit trader, I wasn't a pit trader in, let's say, the crude oil pit, but I'll use crude oil for an example. Nowadays, it can move $1 very quickly on a tweet or some news that comes out, let's say an inventory report that comes out that's not as expected. And sometimes in the last month or so, there was a day that oil moved, $2.50 per barrel in about a half hour. In the old days, when there were pits, you just didn't see volatility like that. You didn't see such excessive movement. It would take more time for those type moves to occur that take sometimes minutes now. And that I attribute to the machines and the fact that so many programs do the same thing at the same time. And I can't necessarily say that it makes the markets more efficient. The moves become so excessive these days that it definitely becomes harder to trade certain markets. And that I attribute truly 100% to the machines. And it makes me not terribly a fan of them. And having been a pit trader and knowing how efficiently humans, and for all those years before computers came about, humans ran and created very efficient market pricing. I think you have excessive volatility because of machines playing the markets the way they do. And to understand that playing the markets yourself now ends up being a more difficult game than in the past. And if you've been trading for 20 or more years, one needs to adjust to the fact that this is not the same game we're playing now as, let's say, we were playing pre-2000. So be mindful of it, and essentially I'm telling or suggesting to your listeners to understand that this is not your dad's or grandpa's stock market or commodities market. It's a different game because of the computers. And statistically, people see all the time that they're almost always wrong the moment they get into the market. Computers just have a sense of being able to read orders, and especially market orders. You sell something at the market to get short, it's almost, always in your face. In the case of crude oil, it can be 10 or 20 cents the moment you sell something. It's uncanny. And that, again, is very different than it used to be. So.
Okay. Many thanks for your time today, Rick. It's been a pleasure having you on the show.
Karim, thank you so much for having me. My pleasure joining you.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?